In this video, we're going to talk about Progenity, trading under the ticker symbol PROG. Before the video begins, just a quick heads up that not all my videos are made on the same day they're posted. If there are material events that happen afterwards, I will make a follow-up video to reflect those changes. With that being said, let's begin with today's video. Progenity is a small-cap company operating in the sector of biotech, and it develops products like molecular testing. Looking at its projects, it feels like what it does is similar to what Bionano Genomics does. They may take a while before they have actual operational cash flows going in, and meanwhile, the fundamentals may not look that pretty, and they may have to dilute the shareholders in order to stay afloat. So these are generally speaking the downsides of owning an early stage startup, or in this case, a biotech company. It's always going to be, how can I put this? It's always going to be something that you have to keep in mind when investing in a company like this, and the same goes for Bionano Genomics as well. Looking at the stock price of Progenity over the past few sessions and weeks, it seems like the share price has been slowing its downward pressure and has found some support, and significant ones at that, at $1.28 level. The market participants are willing to believe in an eventual tide reversal at the end of this short squeeze, and this is why we should never rule out the scenario, even if right now the selling side is having the momentum. Now, keep in mind that for many of those short squeezing stocks, we should never just assume that the short operation is still going on. So even if the short volume remains very high, at some point, I think that we just have to view them as simple opportunities to put in your money in or out, or standing aside of it. So let's say for stocks like Ethereum or Progenity or Vinco Ventures, it's just like any other stock, right? You go in, you see if it's sufficiently low for the downside to be significantly lower than the upside, and then you put your money in. This is at least how I view those stocks. So, of course, sometimes we may also hope that the short squeeze goes through, and then there's like the magical moment similar to what happened to AMC or to GameStop. But that moment, to be honest, is still a bit far away from us. Right now, it's more about identifying a decent entry point to have a calculated exposure in Progenity. The profit target will come at a later stage when the price actions would suggest the worst is behind us. Right now, I'm not sure that this moment is behind us yet. My overall opinion on the company remains overall bullish, partially because I would never recommend to short sell this stock to begin with without hedging your positions. Partially because I truly believe that the risk of shorting is very large compared to holding it long. The alternatives are to either hold a long position or to stand aside and to wait for better opportunities to present themselves. Right now, the market has shown us that it is bouncing off the $1.28 level, and we should be able to see if there are any support being shown over the next few weeks. Now, let's also take a look at the technicals of Progenity. The trade volume of Progenity has recently been 7.2 million shares a day, and the average volume has been 11.8 million shares. Over the previous 52-week period, its price fluctuated between 65 cents and $7.26. The market cap of Progenity is currently at $221 million, compared to an enterprise value of $248 million. So it's quite close to the enterprise value, also called EV, but it's slightly at a discount, and we're going to talk about some of the potential reasons why that's the case. Some of the reasons why there may be a discount is maybe the company is highly leveraged, or if the company is under a lot of selling pressure from an organized shorting operation. If the company is highly leveraged, then this may have a negative impact on the company's profitability, attractiveness, and even the solvency. So we talked about the difference between EV and market cap. One key element to note regarding the enterprise value is that for many growth type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation to the market that for the market that this company is able to generate more profit or grow more rapidly than a rival company. Partially, let's say it may have a good expectation on the management, better brand recognition, or bigger online following, and so on. Basically, what makes this company special? What makes this company better than other ones in the same sector? In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap may be lower in those cases than the enterprise value if you include in the goodwill. And keep in mind that in the case if a company goes to liquidation, we won't be able to distribute the goodwill, which will go to zero, and we will be left with potentially less assets to distribute than what we think there is if we just look at the balance sheet balance. In comparison to its historical price fluctuations, the stock is 21.6% higher than a 1-month low, 21.6% higher than the 3-month low, and 100.5% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility here is 153% compared to a historical volatility of 108%. The put-call volume ratio is currently at 0.22. It's normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 5.7 thousand contracts a day compared to the 30-day average of 15.1 thousand. In terms of open interest, the most recent volume of open interest has been 164,000 contracts compared to the 30-day average of 270,000 contracts. Regarding the shareholder structure, institutional shareholders own about 27% of the company. The biggest shareholders include Group 1, Vanguard, and Renaissance Technologies. Understanding the shareholder structure is relevant to an extent because it helps to determine whether you should be holding the stock in the long term or to simply view it as a short-term trading opportunity. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since many titles are mostly held by retail investors and not institutional investors. But that tends to be the exception and not the rule. Let's also take a look at short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes there are significant short interest in the total volume, and it can be a sign that there is an organized shorting operation currently going on, like what has been going on with GameStop and AMC. The current short interest is 9.7% of total float and 47.3% of the dark pool transactions. Now, let's take a look at the indicators as well. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are currently showing 0 sell, 9 neutral, and 2 buy, with an overall tendency of buy. The moving averages of the past price actions show 14 sell, 1 neutral, and 0 buy, with an overall tendency of strong sell. Now, keep in mind that the indicators may show us the present and the past performances of the stock, but it doesn't tell us what the future necessarily has for us. Nevertheless, they are relevant, in my opinion, to determine if the timing of the trade is a good one. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $1.69, $1.83, and $1.96. For the resistance levels, they are $2.22, $2.35, and $3.81. My recommendation is to make sure that your exposure on Progenity remains below 1% of your portfolio and to enter in the stock within the next week or so if the tendency maintains itself. It would be recommended to buy the stock in batches between 25 to 40% of your allocation at the current price level, assuming that it holds. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.